Why smart investors love mortgage brokers. One of the biggest mistakes investors make is assuming every lender has the same rules. And once investors figure out that's not true, the entire mortgage world starts looking completely different. Hey guys, this is Sal Basio with Mortgage Universe on YouTube. Because I can't tell you how many times I've seen a borrower get declined somewhere, then get approved somewhere else with almost the exact same scenario. And people always think, wait, how's that even possible? Well, here's why. Every lender has a completely different risk appetite, especially in the DSCR and non-QM world. One lender may love short-term rentals, another may hate them. One lender may allow lower credit scores, another may require massive reserves. One lender may be aggressive on leverage, another may get nervous immediately. One lender may love rural properties, and another may flag them constantly. And that's when this gets way more nuanced than most people realize, because most consumers still think mortgages are basically a rate is a rate. But that's not even close, especially once you start dealing with investors, self-employed borrowers, DSCR loans, 1099 income, complex properties. Now suddenly, lender overlays become a huge deal. And that's one of the biggest advantages mortgage brokers have, access. Because brokers are constantly comparing guidelines, risk appetite, pricing, property restrictions, reserve requirements, DSCR calculations across multiple lenders at the same time. That's a completely different world than walking into one retail bank and hoping they like your scenario. And by the way, if you guys are into these kinds of conversations, real estate investing, DSCR stuff, definitely like and subscribe because I'm going to be talking a lot more about this kind of stuff. Now, obviously, not every deal magically works somewhere. A weak deal is still a weak deal. And what most investors don't realize is sometimes the issue isn't always just the borrower. It's the lender fit. That's a massive distinction. I've seen investors get told this property won't work, when the reality was this property won't work here. Huge difference, especially with DSCR loans, because every lender calculates risk differently. Some are more aggressive with Airbnb income, some are stronger with LLC ownership, some allow lower DSCR ratios or no ratio. Some are better with unique property types. And that's why experienced investors actually stop sharing, experienced investors eventually stop shopping only for rates and start shopping for, lender fit, structure, and scalability. Because once you own multiple properties or have layered income or start scaling aggressively, financing strategy becomes incredibly important. So this is where a lot of newer investors accidentally slow themselves down. They spend all their time looking for the lowest rate, while experienced investors are often focused on the right structure and understanding that the rate, can be a little higher, because the wrong lender can kill, your time, kill your momentum, kill your cash flow, future scalability. Even if the rate looks great up front, and over time, investors start realizing the financing itself becomes part of the investment strategy, not just the property. That's a huge mindset shift, because eventually smart investors understand they're not just buying real estate anymore. They're building relationships. They're building lender access. They're, building scalability, flexibility, and financing systems that allow them to continue growing long-term. And truthfully, that's one of the biggest reasons experienced investors usually love working with strong mortgage brokers, because once deals become even slightly complex, having access to multiple lending strategies becomes an enormous advantage.